studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
One of the most common mistakes in compensation planning is focusing only on the corporation. A business owner may come to an advisor asking whether they should take salary, dividend, or some combination of both. At first glance, it may seem like the answer depends entirely on the corporation's income. But professional advisors know that compensation planning is much broader than that. To make a good recommendation, you must understand the client's entire income picture. That is the central lesson of this slide. At the center of the slide, we see an advisor looking through a magnifying glass at corporate income. The focus is narrow. The advisor is only examining salary and dividends coming from the corporation. This represents an incomplete analysis. While corporate income is important, it is only one piece of the puzzle. If we focus exclusively on the corporation, we may miss information that significantly affects planning decisions. On the left side of the slide, we see the risks associated with this narrow approach. The first risk is incorrect tax assumptions. Tax planning decisions are heavily influenced by income levels and tax brackets. If other income sources are ignored, the advisor may underestimate or overestimate the client's actual tax situation. The second risk is missed planning opportunities. Important strategies often depend on understanding the complete financial picture. If the advisor only looks at corporate income, opportunities related to investments, pensions, rental properties, or family income may be overlooked. The third risk is inaccurate recommendations. A recommendation that appears efficient when viewed in isolation may be completely inappropriate once all income sources are considered. And finally, there is the risk of seeing only part of the story. Good planning requires complete information. Without it, decisions are being made with an incomplete picture. Now look at the right side of the slide. This illustrates the broader perspective used by experienced advisors. Instead of focusing only on corporate income, they review all relevant income sources. Corporate income is included, but so are employment income, investment income, rental income, pension income, and other sources of income that may affect the family. This broader review creates a much clearer understanding of the client's financial reality. The flow diagram in the center summarizes the process. All income sources are combined. This creates a total family income picture. That total income affects tax brackets and tax rates, and those tax consequences influence compensation planning decisions. This sequence is extremely important. Compensation recommendations should be based on the complete picture, not on one isolated number. At the bottom of the slide, we see puzzle pieces coming together. Each puzzle piece represents a different source of income: salary, dividends, investments, rental income, pension income, and spouse income. Individually, each piece provides information, but only when the pieces are assembled together do we see the complete picture. The quote at the bottom captures the lesson perfectly. You cannot plan compensation properly if you only look at one source of income. This principle applies to every compensation planning engagement. Before recommending salary, before recommending dividends, before discussing tax strategies, the advisor must understand where all income is coming from, because tax planning does not occur inside the corporation alone. It occurs within the context of the family's overall financial situation. The key takeaway from this slide is simple. Corporate income is important, but it is only one part of the planning process. The best recommendations are built on a complete understanding of all income sources that affect the family. Because the more complete the picture, the better the planning decisions will be. To make effective compensation recommendations, Advisors must understand more than just the corporation. They must understand the family's complete financial picture. That is the focus of this slide. At the center of the slide, we see a family surrounded by multiple income streams flowing into the household. This visual represents an important reality. Most families do not rely on a single source of income. Instead, income often comes from many different places, and every one of those sources can affect tax planning decisions. Let's start with the income streams shown at the top of the slide. The first is corporate income. This includes salary, dividends, bonuses, and other amounts received from the corporation. For many business owners, this is the most visible source of income, but it is not the only one. The second source is employment income. A spouse may work outside the business. The owner may have employment income from another source, or family members may have additional earnings that contribute to the household. Next comes investment income. This may include interest, dividends, capital gains, or income generated from investment portfolios. Investment income often affects tax brackets and can influence compensation decisions significantly. We also see rental income. Many families own investment properties that generate additional cash flow. These income streams may appear unrelated to compensation planning, but they directly affect the family's overall tax position. Pension income is another important consideration. CPP benefits, old age security, company pension plans, RRIF withdrawals, and other retirement income sources may already be contributing to the family's cash flow. Finally, there may be other income sources, such as trusts, side businesses, royalties, consulting income, or other arrangements. The key message is simple. Every source of income matters. Now let's look at the left side of the slide. Here we see the business owner's income profile, salary, dividends, and investments. These are often the primary areas advisors focus on when discussing compensation planning. But look at the right side. The spouse may also have employment income, business income, investment income, or pension income. When these amounts are combined, they may dramatically change the family's overall tax situation. This is why understanding the spouse's income is so important. A compensation strategy that appears efficient when examining the owner alone may look very different once the spouse's income is included. At the center of the slide, we see the planning process. All income sources are combined. This creates total family income. Total family income determines tax brackets and tax rates, and those tax consequences influence planning decisions. This sequence is critical because compensation planning is ultimately about managing the family's overall financial position, not just the corporation's income. The section at the bottom explains why this matters. First, accurate tax planning. The more complete the income picture, the more accurate the tax analysis becomes. Second, better strategies. Some planning opportunities only become visible when all income sources are considered together. Third, reduced risk. Understanding total income helps avoid unpleasant tax surprises. And fourth, stronger outcomes. Plans become better aligned with the family's goals and financial realities. The statement at the bottom captures the entire lesson perfectly. The corporation is only one part of the family's financial picture. That is one of the most important ideas in compensation planning. The corporation may generate income, but the planning decision should be based on the entire family situation, not just one income source. The key takeaway from this slide is simple. Before making compensation recommendations, understand where all income comes from. The owner's income, the spouse's income, investment income, rental income, pension income, and any other relevant sources. because the more complete the income picture, the better the planning decisions will be. And better planning decisions lead to better outcomes for the family. This final slide brings together the most important lesson of this section. The best compensation plan is built using the family's total income picture. Many business owners approach compensation planning by focusing on one question: how much should I take from the corporation? But experienced advisors ask a much broader question: how does the corporation fit into the family's overall financial situation? That difference in perspective is what separates basic tax planning from comprehensive tax planning. At the center of the slide, we see the complete compensation planning process. Everything begins with a review of total family income. The advisor gathers information about every significant source of income affecting the household. This includes the owner's income, the spouse's income, investment income, rental income, pension income, and any other relevant sources. Only after all of that information has been collected does the planning process begin. The first stage is income analysis. The advisor combines all income sources to understand the family's complete financial position. This creates the foundation for every recommendation that follows. The second stage is tax bracket analysis. Once total income is known, the advisor can evaluate the family's current and future tax exposure. This step is critical because tax brackets influence many compensation planning decisions. The third stage is identifying planning opportunities. With a complete understanding of the income picture, strategies can be explored that may improve tax efficiency, increase cash flow, or better support the family's goals. The fourth stage is reviewing salary versus dividend options. At this point, compensation decisions are no longer being made in isolation. They are being evaluated within the context of the family's overall income situation. Finally, a recommendation is made, and that recommendation is designed to support the family's objectives rather than simply minimizing taxes in a single year. At the center of the slide, we see the advisor using a family income dashboard. This visual reinforces an important concept. Modern compensation planning is data-driven. The advisor reviews income levels, tax rates, cash flow, and future projections. All of these inputs contribute to a more informed recommendation. Notice that the recommendation is not based on a single number. It is based on the complete picture. On the right side of the slide, we see several questions every advisor should ask. Does the spouse have income? What tax bracket is the spouse in? Are there investments? Are there rental properties? Are pension benefits being received? And are income levels expected to change in the future? These questions may seem simple, but they often reveal planning opportunities that would otherwise be missed. The quality of the recommendation depends heavily on the quality of the information gathered. At the bottom of the slide, we compare two approaches. The first approach ignores other income sources. This creates incomplete planning, tax surprises, missed opportunities, and recommendations that may not fully support the family's goals. The second approach focuses on understanding total income. This leads to more complete planning, better tax analysis, more planning opportunities, and ultimately better outcomes. The strategy becomes more accurate because it reflects reality rather than assumptions. The statement at the bottom summarizes the entire lesson. The best compensation plan is built using the family's total income picture. This is a principle that every advisor should remember. The corporation is important, but it is only one part of the family's financial life. Compensation planning should never be based solely on corporate income. It should be based on the complete financial picture of the family. The key takeaway from this slide is simple. Gather all relevant income information. Analyze the family's total income situation. Understand the tax implications. And then build a compensation strategy that supports the family's overall goals. Because the best planning decisions are made when the entire picture is visible.